American investors need to make sure they consider the opportunity in international equities. This isn't particularly easy since, measured in US dollars, both international developed country stocks and emerging market stocks have underperformed the US market in recent years. However, much of this underperformance has been due to a currency effect. As the US dollar has risen, it has reduced the dollar value of international stocks. Having said this, long-term investors should note two things. First, while the US dollar has soared in recent years, it may well come down over the next few years due to a large US trade deficit, the prospect of slower growth in the United States, and a much diminished commitment to maintain a high dollar from the incoming administration. Second, as we show on page 43, from an earnings and valuation perspective, there just seems to be more opportunity in international stocks than in US stocks right now. On the left-hand side, we show that US S&P 500 earnings per share are expected to rise to an all-time high over the next year, while PE ratios are above average. However, in Europe, profits have a long way to rise just to get back to pre-financial crisis levels. In addition, PE ratios are somewhat lower, and the comparison to local bond yields is even more striking than in the US. This is also the case for emerging market stocks, where both the potential long-term rebound in earnings and current relatively cheap valuations make EM stocks more attractive.